$58 a barrel. That was the dream. That was the official, government-stamped, expert-approved forecast for 2026. Brent crude averaging $58. The U.S. Energy Information Administration published it on February 10, 2026. The World Bank backed it up with their own number, $60 a barrel, in what they cheerfully called a global oil glut scenario. Supply was going to exceed demand. Inventories were going to rise. Oil was going to be cheap. 18 days later, the bombs started falling. And that $58 dream? Gone. Just gone. By March 9th, Brent crude hit $119.50 a barrel, intraday. That's not a typo. $119.50, more than double the forecast that was published less than a month earlier. Here's the thing that should keep you up at night. The people who made that forecast, they weren't wrong about the data. The supply numbers were real. The demand projections were reasonable. The models worked perfectly, right up until the moment they didn't. Because nobody modeled a war. And that right there, is the whole story. February 27th, 2026, the last normal trading day. WTI crude sitting at $66.96. Brent at $71.32. The 10-year Treasury yield at 3.97%. Markets were calm. Boring even. The IEA had just published its oil market report on February 12th, projecting supply would grow by 2.4 million barrels per day in 2026, reaching 108.6 million barrels per day. They noted Brent futures hovering around $70. The narrative was simple. Too much oil, not enough demand, prices going down. One day later, February 28th, the US and Israel launched strikes on Iran. And the narrative shattered.
Now, to understand why this conflict didn't just rattle markets, but absolutely detonated them, you need to understand one tiny, critical detail. One choke point. The Strait of Hormuz. It sits between Iran and Oman. It's narrow, it's shallow in places, and in 2024, according to the U.S. Energy Information Administration, about 20 million barrels of petroleum moved through it every single day. 20 million barrels! That's roughly 20% of the entire world's petroleum liquid consumption, 1/5 of the planet's oil supply, flowing through a strait that Iran can threaten with missiles from its own coastline. Imagine a garden hose watering 5 houses on a street. Now imagine someone putting their boot on that hose. That's Hormuz. And on February 28th, someone didn't just step on the hose. They started shooting at it. Within the first 48 hours, the shipping picture turned catastrophic. Reuters reported near standstill conditions in and around the Persian Gulf. Hundreds of tankers, sitting idle, not moving, not delivering, just floating there, waiting for someone to tell them it was safe. It wasn't safe. March 1st, first real trading session after the war begins. Dutch TTF natural gas futures settle up 40% in a single session, 40%, to €44.51 per megawatt hour. Asian LNG benchmark, JKM, hits $15.07 per million BTU. The world's gas markets looked at the Middle East and collectively panicked.
And for good reason. Qatar, one of the world's largest LNG exporters, halted production at Ras Laffan and declared force majeure. Force majeure. That's the corporate version of throwing your hands up and saying, sorry, war happened, we can't deliver. And this wasn't some minor disruption. More than 80% of Qatar's LNG shipments go to Asia. Taiwan alone gets more than 40% of its electricity from LNG, and roughly a third of its LNG supply comes from Qatar. So when Qatar says, we're done for now, Taiwan starts sweating, Japan starts sweating, South Korea starts sweating, the whole continent starts sweating. But wait, it gets worse. It wasn't just Qatar. In the first 2 weeks of the conflict, the dominoes fell one after another after another. Saudi Aramco, the biggest oil company on earth, began cutting output at 2 oil fields. Scale? Not disclosed, because why would they tell you how bad it is? Iraq slashed output at its main southern oil fields by 70%. 70! down to 1.3 million barrels per day, according to industry sources cited by Reuters. Kuwait Petroleum Corp declared force majeure and cut output. Bahrain declared force majeure. Country after country after country shutting down. Analysts estimated, and this is a Reuters-reported estimate, not an official audited number, that the war cut global oil supply by 200 million barrels in just 10 days. Reuters also described the early disruption as suspending around a fifth of global crude and natural gas supply. A fifth of the world's energy supply suspended. So what happened to prices? You already know what happened to prices. Let me walk you through the escalation, because the speed of it is almost beautiful in a horrifying kind of way.
February 27th, last normal day. WTI at 66.96. Brent at 71.32. March 2nd, 4 days into the war. WTI jumps to 71.13. Brent to 77.24. A spike, sure, but markets are still processing, still hoping this blows over. March 5th, 1 week in, WTI settles at 81.01, Brent at 85.41. Okay, not blowing over. March 9th, bam, WTI settles at 94.77, Brent settles at 98.96, and intraday? Brent touched $119.50. WTI hit $119.48, the highest level since 2022, from $67 to nearly $120 in 10 days. Remember the experts saying $58 for 2026? 58. That number aged like milk in the sun. And here's where the story stops being about oil traders and starts being about you. About the person filling up their car, about the person buying groceries, about the person just trying to live. Because oil prices don't exist in a vacuum. They're a tax on everything. New York Harbor regular gasoline spot price, $2.07 a gallon on February 27th. By March 2nd, $2.39. That's the wholesale price jumping 15% in days. But the pump price, that's where it really hurts. U.S. retail gasoline went from $2.94 a gallon on February 23rd to $3.32 a gallon by the first week of March. That's an 11% jump week over week, according to AAA data cited by Reuters. Diesel, even worse, $4.33 a gallon, up 15% in a single week. And diesel isn't just for trucks. Diesel moves everything. Every product you buy at a store got there on diesel. Every piece of food, every package, every delivery. When diesel goes up 15% in a week, that cost doesn't vanish. It gets passed to you, the consumer, the one at the end of the chain who gets to absorb everyone else's higher costs. Isn't economics fun?
Now let me tell you about the part nobody was talking about in the headlines. The food chain. Because this war didn't just mess with oil and gas. It went after the thing that keeps people fed. Fertilizer. Nobody thinks about fertilizer until they can't afford food. U.S. fertilizer prices in New Orleans shot from $516 per metric ton to $683 per metric ton shortly after the outbreak. Multiple producers were shut down or constrained. And here's the gut punch. According to a grain saw statement quoted by Reuters, fertilizer can represent up to 50% of production costs for some farmers. Half. Half of what it costs to grow your food just got 32% more expensive overnight. The result? Wheat surged to its highest level since June 2024. Corn hit a 10-month high, and planting season hadn't even started. So you've got more expensive fuel to ship more expensive grain, grown with more expensive fertilizer, delivered by more expensive freight. VLCC shipping rates on the Middle East to China route hit $423,736 per day. Per day. LNG freight rates spiked more than 40%. Every single link in the supply chain repriced, all at once. And the bond market saw it coming. The bond market always sees it coming. The U.S. 10-year Treasury yield jumped from 3.97% on February 27th to 4.15% by March 6th. The 2-year yield moved from 3.38 to 3.57%. The 5-year break-even inflation rate hit 2.56%. That's the market literally pricing in higher inflation. What does that mean in plain English? It means the market was screaming, inflation isn't dead, it's coming back. and someone's going to have to raise rates to fight it.
Money markets in Europe started pricing in rate hikes. The ECB, the Bank of England, the Swiss National Bank, the Riksbank, all of them suddenly facing the nightmare scenario. Energy prices spiking while the economy weakens. The classic trap. Raise rates to fight inflation, and you kill growth. Keep rates low to support growth, and inflation eats everyone alive. Sound familiar? It should, because we've been here before. 1978 to 1979, the oil shock. Same playbook. Middle East supply disruption, oil prices surging, inflation spiraling. By the end of 1979, U.S. 12-month CPI inflation hit 9%. 9%. According to Federal Reserve history, that shock fundamentally changed how central banks thought about energy and monetary policy for a generation. Now, to be fair, and I try to be fair occasionally, the Fed itself has noted that the U.S. economy is more energy resilient now. The U.S. only received about 0.5 million barrels per day of crude through Hormuz in 2024, roughly 7% of U.S. crude imports and just 2% of total U.S. petroleum consumption. So America isn't as directly dependent on that strait as it was in the 70s. But here's the thing about oil. It doesn't care about borders. Oil is priced globally. When Brent hits $119, it doesn't matter that most of your oil comes from Texas and Canada. Your price still goes up, because the global price is the global price. The Fed acknowledged this. They flagged inflation and financial market transmission channels even while emphasizing U.S. energy sufficiency. You can be the biggest oil producer in the world and still get wrecked by a price shock, which is exactly what was happening. The stock market? Oh, the stock market was having a wonderful time. Just wonderful.
March 5th, Dow down 1.61%, S&P 500 down 0.56%, Nasdaq down 0.26%. Airlines got absolutely destroyed. And why wouldn't they? Fuel represents 20 to 25% of airline operating expenses, and jet fuel prices had reportedly doubled since the conflict started. Korean Air dropped 8.6%. Air New Zealand fell 7.8%. Cathay Pacific down 5%. European carriers lost 2.5 to 6%. In the U.S., JetBlue cratered 5.35%. American Airlines dropped 3.44%. You know what did hold up on March 9th? Semiconductors. Because apparently the market decided that even in a world on fire, you still need microchips. The S&P 500 actually closed up 0.83% that day, the Nasdaq up 1.38%. Late session hopes of some kind of resolution offset the morning panic. But the bounce didn't change the underlying reality. The damage was structural. It was in the supply chains. It was in the freight costs. It was in the fertilizer prices. It was already flowing into the grocery stores and the gas pumps. Gold, the classic "the world is falling apart" trade, did something interesting. It spiked to $5,297.31 per ounce on March 2nd. But then it actually fell to $5,076 on March 5th and $5,091 on March 9th. Why? Because a stronger dollar and rising rate expectations were competing with safe haven demand. War says buy gold. Higher rates say gold pays no yield. And in this case, the rate expectations won, at least for the moment. The IMF issued a public statement on March 3rd confirming they'd observed surges in energy prices and volatility in financial markets. Their official assessment? It was too early to assess the full impact. Helpful. Very helpful. Thank you, IMF.
Meanwhile, in Pakistan, and pay attention to this because this is what happens to countries that can't absorb the shock. Pakistan's central bank held its policy rate at 10.5% on March 9th, explicitly citing oil risks. Their headline inflation had already jumped from 5.8% in January to 7% in February. Core inflation was running at 7.6%. And the government's response? Fuel-saving austerity measures, school closures, a shortened work week, and a petrol and diesel price hike of 55 rupees per liter. School closures, because oil got expensive. Think about that. And Japan.
Japan gets roughly 95% of its oil supply from the Middle East. 95%. According to the EIA, 84% of all petroleum flowing through the Strait of Hormuz in 2024 went to Asia, with China, India, Japan, and South Korea accounting for 69% of those flows. The International Energy Agency, the IEA, called for a coordinated release of emergency oil reserves at a G7 finance ministers meeting. Japan's finance minister confirmed it publicly. This is the break glass in case of emergency lever for global energy. They were pulling it. And hovering over all of this, a scenario that was being discussed, reported by Axios and cited by Reuters, of the US and Israel potentially seizing Karg Island, Iran's key oil export terminal. If that happened, Iran's exports would stall, output could halve, and the crisis that was already rewriting global energy markets would get exponentially worse. The plan was never to have cheap oil. Not really. The plan was a forecast built on the assumption that nothing bad would happen. That's always the plan, isn't it? Let me line this up one more time, because the speed and the cascade is what makes this story insane.
February 5th, EIA finishes its model. $58 oil. Life is good. February 12th, IEA publishes its report. Supply exceeds demand. Oil glut incoming. Brent around $70. February 27th, markets close. Calm. Normal. Boring. February 28th, war starts. March 1st, gas markets spike 40% in one session. March 3rd, IMF says too early to tell. Asia scrambles for LNG. Taiwan realizes a third of its gas comes from a country that just went dark. March 5th, global markets reprice. Stocks fall, yields rise. Brent closes at 85.41. March 6th, U.S. pump prices visible. Gasoline up 11%, diesel up 15%. In a week. March 9th, shouting, Brent touches $119.50. IEA calls for emergency reserves. Central banks reprice toward hikes. Airlines in freefall. Fertilizer through the roof. 10 days. The entire global energy and financial landscape rewritten. And the forecast said $58. History doesn't repeat, but humans stay stupid. Every time we build a model, every time we project a nice clean future, every time we say supply will rise and prices will fall, we forget the one variable that always shows up uninvited. War, politics, human stupidity on a geopolitical scale. You want to know the really dark part? We've seen this movie before. 1978. Different war, different Strait, different decade. Same boot on the same hose. CPI hit 9% by end of 1979. Central banks scrambled. Economists wrote papers. Governments made speeches. And then we built our entire 2026 energy forecast on the assumption that the Middle East would stay quiet. $58 a barrel, because we totally learned our lesson. $58 a barrel. That was the dream. The dream lasted 18 days.
The plan was never to prepare for the worst. The plan was to assume the best and hope nothing bad happened. And when something bad happened, as it always does eventually, the whole beautiful forecast, every chart, every model, every carefully constructed projection became worthless. Overnight. And the price of that wishful thinking? You're paying it right now. At the pump, at the grocery store, in your mortgage rate, in your airline ticket, in the price of literally everything that moves, grows, or gets shipped. Good thing we learned from the 1970s, right? Good thing we diversified our energy dependence and stopped building our entire economic forecast on the assumption that the Middle East would remain peaceful forever. We didn't. We never do. That's the whole point of Money Never Learns. Most people will scroll past this video and fill up their tank tomorrow without thinking twice about why it costs what it costs. Because it's just the price, right? It's always been that price. Totally normal. But now you know it's not normal. Now you know there's a war premium baked into every gallon, every shipment, every loaf of bread. And most people will forget this by next week and go back to wondering why everything's so expensive.
If you'd rather see the next one coming, subscribe button's right there.